Silver Dave here, and I want to talk about something quite interesting. If you have been following the news and been following what's going on over the whole market, the stock market, the silver market, silver squeezes, gold squeezes, you've been thinking, are we in a bubble, right? Are we right now in a bubble? Well, let's find out if we are in a bubble. I've been trying to figure out if we are in a bubble or not for quite some time. Because I stack silver and I stack gold, and I'm thinking, when will the crash come? Are we right now in a bubble? Well, I've been looking at a few different things, and one of the things I'm trying to figure out is sort of what does a bubble look like? What are some things that can tell us whether we are in a bubble or not? And one of the things I've noticed that's quite interesting is that interest rates do have a very special shape when you go into bubble territory. And it's called the yield curve analysis. And I've been looking at the yield curve, for example, in 2008. And in 2008, the yield curve, the trend, it looked like crazy. It was completely insane. I have trend lines superimposed over the yield curve. It's somewhat positive. Sometimes it goes flat. You have different types of inversions in different areas. And you could also see this throughout 2007. You have inversions in the yield curve. The yield curve in 2007 was actually inverted, right? The trend for the yield curve was completely inverted. We had this in 2019. We had a tendency towards inversion. And we had a completely catastrophic yield curve. If you look at this as a 2020 yield curve, which I think, even if the pandemic did not hit, it would have been possible for a recession, like a total market crash in 2020. I do also say on my channel that, the pandemic and the market crash during the pandemic has been sort of masked a lot of the underlying issues that would have happened maybe even without, the current environment and the crash and the lockdown crash. So right now, what does the yield curve look like? Like at least in the month of February and also potentially start since the beginning of the year. Well, I took my information from the United States Treasury website. You can look up, they have the yield curve for the different months. And pretty much it's a normalized yield curve. It's a very, very standard yield curve where there is, in the short term, the interest rate is low, and the long-term interest rate is relatively high to the low interest rate. And we've seen this before. We've seen this type of, I would say, yield curve in 2013 when they did the the third wave of QE. And they've applied yield curve control. And what happened is that overall the market, it was booming, right? It caused a financial boom. And is it possible that we'll see a financial boom? It's possible that coming out of winter and going into spring and summer, we could see some growth because of this current situation. It is artificially made. It is not due to free market forces. It's purely intervention. It is, if they were to step off the money printing gas pedal, we probably will have a crash. And we'll see it also in the yield curve. We'll see it in overall all the markets. But what does this mean for gold and silver? Well, it's a bit of a conflicting news for gold and silver. Now, if we look at the silver, right, I've been tracking silver and doing predictions on silver. I've been constantly doing this. I've been working on my program to make the publication a little bit smoother, and we're seeing that in the long term, silver outlook is getting more and more positive. There were a few jumps during the last 2 weeks, when there was this sort of like silver squeeze where it went up almost by like 5-6% during the course of a day, which is something very rare for silver. But silver is getting quite volatile, and it's trending towards the upside as economies open, demand picks up. Silver is highly industrial. It's used in a lot of industrial applications, so it is sensitive to industrial demand. Now, one metal that is almost purely industrial, that is platinum, is picking up. I said that platinum was looking to be picking up around, I think it was already around December. I was saying that, we might see a breakout for platinum. I'm seeing that it's hitting the upper bounds. It didn't completely break out the upper bounds in January. Then mid-January, I said, look, I'm buying more platinum. I have bought 2 ounces of platinum since I was looking at this chart. Pretty much I was buying 1 ounce of platinum every other month. And when I first started doing the analysis, I was like, it's an undervalued metal. It has a lot of applications, specifically industrial applications for the synthesis of synthetic materials. It's a catalyst used in a lot of plastic manufacturing, synthetic materials manufacturing. And you also need, for example, if you're making hydro, like a disinfectant for your hands, right, made out of alcohol. Well, the alcohol is usually synthesized from crude oil, and you need platinum to get to the final product as the catalyst for the different reactions. So, alcohol demand is up for disinfectants, and that's going to drive the increase in platinum demand. And we see a breakout in platinum. Despite so much like money printing, you would expect gold to rise, but gold has been stable. It's been flat. I think gold will pick up once, the economies fully reopen and there is more demand and there is more jewelry demand. There's no more industrial demand for gold. Gold might actually also pick up from that side. You have to remember that currently gold's price is where it's at with no industrial demand. It was almost, I think jewelry demand is down like 50 to 60% this year. And a lot of the industrial applications for gold have also been down for the year. So when that picks up, potentially we can see higher gold prices. But the price for gold has been relatively stable, except for the last few days. I think we're seeing more volatility, but overall, it's been quite stable. Crypto is crazy as usual. I've been tracking crypto too. And it looks, I wouldn't say it's bubble territory, but it's the fact that the valuation of cryptocurrencies, it's too uncertain. People don't know how to exactly value it. Is it valued because Elon Musk buys into cryptocurrency and Tesla's buying cryptocurrency? Should it be worth more or less? What is its intrinsic value? And I think it's in an unknown. My personal approach to it is I think I will wait a little bit until it stabilizes and see where it goes on from there. I do own some cryptocurrencies from a long time ago. I have never sold it. It's in a hardware wallet stored in the safe. So yeah, I'm not on Coinbase trading cryptocurrencies, in a very active manner. I'm more like stacking cryptocurrencies for the very, very long term. And just like I do for silver and platinum and gold. I think if you're in the long-term approach, you're going to be okay. And I found something very interesting is that there is something called a luxury index, and they do track the return on investment coins over the last 10 years. And for investment grade coins, it's about 193% over the last 10 years, at least to 2019, probably slightly higher this year. And that is actually comparable to the S&P 500. So if you are a long-term stacker and you just hold on to your coins for until your retirement, it's a decent and safe bet, really. It's really a safe bet. But from my perspective and at the information I've been looking at least I see that, all the industrial metals like platinum have been picking up since the beginning of the year. There's some movement, but really it's been picking up quite strongly since the beginning of the year. I see that oil is picking up in a very, very aggressive manner. I mean, oil is almost breaking $60, right? It had one boost in February, and then now it's almost in just like a straight line upwards. Now, I did a lot of videos in the past where I said, look, if the price of oil keeps rising, what you're going to see is a price of metals will rise along with it, because the supply of metal being produced at a lower cost will simply not be as feasible if oil was cheaper. And potentially, we could also see more inflation as energy prices rise. However, we're not seeing a rise in energy prices because people are traveling less. So you must ask me, why is oil prices rising if people are traveling less? And the answer is very simple. Manufacturing has increased. And actually, manufacturing uses pretty much the 60% of oil that's not gasoline, right? 40% of the oil is gasoline. The other 60% is not gasoline. And the 60% that is not gasoline is used for the synthesis of plastics, of alcohol, of sunscreen, of consumer products. It's also used in fuel oil, diesel engines, transportation. It's used in a whole field that's not related to cars and vehicles. So if that demand is actually driving the increase of crude oil, and that demand, when it rises to a certain level, it becomes relatively inflexible. It doesn't come down as easily. Unlike personal consumption in gasoline, it tends to stay at the higher level. And I think we are going to stay at the higher level because, the United States has been doing a lot of quantitative easing. There's been a lot of money printing. And actually, if you could stack barrels of oil, you would stack barrels of oil. The second best thing is, if you don't have barrels of oil, is to stack platinum, right? I've been telling my viewers of the channel, look, like at least for the past few months, platinum is relatively undervalued. Platinum is relatively undervalued compared to silver, to gold, to the stock market, to industrial demand, and we only have a limited amount of it. And as you can see, how platinum moves, it's very similar to oil, and it has strong upward pressure. How far do I think oil can go? I think oil has an upper limit. Platinum has a less of an upper limit. I think platinum was even more undervalued than oil. But oil has, I would say, after $60, there's a lot of resistance, because at $60+, it becomes extremely profitable for a lot of oil producers to come online. These include all the fracking oil producers in the United States. This includes a lot of oil producers in Russia. It includes a lot of oil producers in the Middle East and North Africa. It includes a lot of oil producers in Latin America. It also means that it's profitable for some oil producers in China, to run those coal conversion plants, and it just means that there will be much more supply at $60+ relative to the current price. And if we do go above $60, the question is, can platinum keep running up? The answer is, I think potentially platinum can keep running up and can even reach the same price that gold is, which means that right now, today is at, $1,200. It can probably reach $1,300, $1,400, maybe even $1,800 if we have sufficient industrial demand. But I do think that there's also an upper limit for platinum, because for all industrial type commodities, they're self-regulating. When they go too high, they tend to calm down a bit, because it's not like buying Bitcoin, which is almost a pure sentiment play. A lot of industrial metals is used by industrial businesses, and they will cut back on production if it becomes too expensive. They'll wait for the prices to drop a bit, buy in a little bit more, and yeah. But it's a good sign that platinum prices are rising. It means that the economy is setting up for a recovery, and oil prices rising is the same thing. It means that the economy is setting up for a recovery. And if we are going into recovery with so much liquidity, I think we will see inflation. We will see increase of consumption. We should see increase in the price of gold. We should see an increase in the price of platinum, silver. Bitcoin is, I don't know. Bitcoin, it can go up, it can go down, it can go sideways, it can go backwards. Stock markets too, I see that the stock market is in an insane rally, where potentially, if we're still heading forward like in an upward trajectory, we're going to see a breakout possibly in the SP 500, and we are going to hit new highs above previous new highs that that will probably be shocked, and people will be in disbelief that we are hitting new highs for these indices, because since the last 10 years they have hit a new high, and they're going even higher. But it's not so surprising if you take into account the fact that there's so much money printed. It's relative to the total amount of money printed, it has not gone high enough. It should be about, I would say, if you apply the multiplier on M1 money, it would be, I would say, if they create 40% more M1 money and you times this by the multiplier, which is roughly 10, we should have a 400% rally in stocks and all hard assets such as real estate and everything. That would be complete insane if you're owners of such assets and you bought on margin and debt and you're able to stay, I would say, solvent during this whole period. You might come out as a big winner, like a really big winner. But if you don't, then you might actually suffer. If you've just been saving money, you might regret it. But overall, if you've been stacking, if you've been consistently stacking, and you build up your security, your physical savings account, I think you're going to do quite well over the next period. I still stack. I will be buying more gold and platinum and silver. Most likely end of the month, I'll see what I buy. The prices have become, when you buy, you're always in this mentality that you're used to the previous prices you bought at. And for me to buy platinum at the current price, which is 1,200, it's a little bit frothy. I've been thinking, it's more than what I paid. I remember paying for sub $1,000 platinum, and now I'm paying like more than $1,000 platinum. And I'm like, and then there's a premium for platinum too on top of it. So I kind of am like on the fence about it. I'm like, not so happy about it. But I do realize that there will be more demand for it. And if you take into consideration the amount of money printed, it's not so surprising to see upward pressure for all metals, even though gold has been trending downwards somewhat over the last 3 months. The midterm, I would say, outlook for gold is quite positive, simply because of the pressure from oil. Oil was so cheap for the last 3 months, and gold is very much tied to oil, and it does tend to be delayed relative to oil. So a lot of people have bought oil over the last 6 months, since the start of the downturn for oil. And right now, oil is coming back very aggressively. So probably in 3 months, we're going to see like an increase in the price of gold, which many people have given up on, because they're looking at it and they're thinking, oh no, it's going downwards from 1900. We're not seeing $10,000 gold. But if oil prices increase and no more new gold that's cheaper is coming online, people are like, yeah, we need to make our margins. We're the miners. We're only going to sell gold at a higher level because otherwise we can't mine it. You might see more upward pressure for the price of gold as new gold is traded at a higher price. Of course, there's always like gold in the overall market, but I would say this year jewelry sales have been lower. Refiners have been refining less gold over the course of this year, even though the price of gold has risen. And a lot of refiners are not able to refine sufficient amounts of gold to meet demand, because there's just isn't that much gold to refine anymore. And it hasn't been so popular to hold physical gold in individuals in the form of jewelry for quite a long time. There was a long time when it was popular to buy gold jewelry, such as gold necklaces and so on. But if you look at today, there are very few people go out wearing yellow gold, wearing gold jewelry. Most people prefer the look of steel. If you look at an Apple Watch, it's not made out of gold. It's made out of steel. Your iPhone is made out of aluminum and it's metallic in color. So, and an iPhone is a luxury product. I'm rambling on, but my outlook is relatively positive. I think that we'll see higher prices for for metals in the long term. We'll see higher prices in the midterm, even though right now we're not seeing higher prices. And if I look at the stock market, I think there's going to be a stock market rally. It will be the rally of everything. Will there be a crash of everything? I think that looking at the yield curve and the interest rates, this is not financial advice. It doesn't, like, I don't have a crystal ball, but if I look at what is the yield curve and what the yield curve was like, over the last few years, right? It does not look like a yield curve in the middle of a crisis. It looks like the yield curve coming out of a crisis, like the yield curve coming out of the 2008 recession. And it looks like a yield curve going into I would say, a booming economy, rather than the start of a booming economy, rather than the end of a cycle. This is the yield curve of 2018. And you can see that, it's sort of like, it's like changing in shape. And it is the yield curve of a end of cycle economy, and the next year in 2019, you start having inversions. I think if 2020, we didn't have, the lockdown and everything, we would still see a correction in the market. Maybe not as severe, maybe 20% rather than 30%, but we were still seeing a correction in the market, a slowdown. And 2020 in March, because of the health situation, the Federal Reserve just got an excuse to print way more money than they ever did, and they just went ahead with it. And they're going to go forward even further. There's a $1.9 trillion package in the talks from in terms of stimulus from the federal government, and then that will further need to be funded with debt. So you will see even more surges of QE. They've talked about at least keeping interest rates low and controlled, and buying back assets for the next 4 to 5 years. So that's pretty intense. So I think we'll see a boom in the market for at least the next 4 to 5 years. For all metals, for stocks, for crypto maybe, but definitely if you're stacking the long-term 30 year, 40 years, I don't think you should be worried too much. You're in the long-term outlook, you're saving, your purchasing power through silver, platinum, gold. I've always been an advocate of actually stacking multiple types of metals, stacking silver, stacking platinum, and stacking gold. I know a lot of my viewers don't like stacking all three. They're like, go all into one type. I think they all have their different up and down periods in the different cycles of an economy, and having all three is not a bad thing. You don't need to be so focused. They all have the inherent similar sort of properties, is that they preserve your purchasing power over time. And if you have a basket of them, they tend to preserve your purchasing power relatively well across different time periods. It's not like buying a company that doesn't have yield or anything, but it's good for preserving wealth. Anyways, thank you very much for watching. And I hope you enjoyed the content, and I hope you enjoyed some of the improvements I've made to my previous analysis and sort of the machine learning output from my predictions. This isn't financial advice. This isn't like, I'm not saying that you should go all in and buy gold and silver, but I'm saying more that, it's for education purposes. It's good information to know that like the yield curve currently looks pretty healthy, and it looks as if it's, even though it's artificially healthy, it is similar to previous yield curves where there was prior to a pretty intense financial boom. I've always compared right now to the beginning of the 1920s, before the Roaring 20s, and potentially, by the end of the Roaring 20s, in 9 years, 8 years, we might see another downturn, and a really severe downturn. And, maybe by then it's good to have a little bit of crypto, a little bit of silver, a little bit of gold, and a little bit of everything that you can carry around and protect yourself. Anyways, thank you very much for watching. This is Dave. It went on a little bit longer than I wanted. If you like the content, click the like button. Remember to click the bell notification button too, and subscribe if you're not a subscriber yet. Thank you very much. Dave out.